All right, welcome back to another episode of the Black Bullion Show. Today we are talking about Glass-Steagall causing the financial crisis and how we are set up today for an even worse scenario. Now, before we get started, if you would like to just not watch the full video and get my general talking points about this, just go into the description below. It's right there. Also, while you're there, please like the video. Please subscribe to the channel if you're new. Liking the video helps to get this economic evangelism out there. So let's get right into it. Now, this is actually an old article from Jim Rickards himself from 2012. And his main case is that what a lot of people were saying at the time was, the whole issue with what was going on at that time was, housing, right? Or, I heard something about, Lehman Brothers and da 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 da. That was the cause, right? And Jim Rickards is saying you have to go deeper, and it starts with Glass-Steagall. Now, I'm not going to read the full thing here, but I am going to read a brief quote that I highlighted here. Banks would be, and this is essentially one of the reasons why the Depression happened. And it's because before Glass-Steagall was put in place, banks, commercial and investors, banks and brokers were essentially allowed to combine their practices together. So I'm going to talk about that in this quote. Banks would be allowed to take deposits and make. In 1933, Congress passed Glass-Steagall in response to the abuses that I just mentioned. Banks would be allowed to take deposits and make loans. Brokers would be allowed to underwrite and sell securities, but no firm could do both due to conflicts of interest and risks to insured deposits. From 1933 to 1999, there were very few large bank failures and no financial panics comparable to the panic of 2008. The law worked exactly as intended. In 1999, Democrats led by President Bill Clinton and Republicans led by Senator Phil Gramm joined forces to repeal Glass-Steagall at the behest of the big banks. What happened over the next 8 years was an almost exact replay of the Roaring Twenties. Once again, banks originated fraudulent loans, and once again, they sold them to their customers in the form of securities. The bubble peaked in 2007 and collapsed in 2008. The hard-earned knowledge of 1933 had been lost in the arrogance of 1999. And as they say, history doesn't necessarily repeat, but it sure does rhyme. That's actually a quote from Mark Twain himself. Now, this is stuff you may know. I'm going to show you something that you may not be aware of. And this comes from a website called demonocracy.info. And I'm going to actually put this in the description as well so you guys can check it out because there are way more economic infographics that they have here. But this one, I'm going to be talking about the FDIC because they're the ones who insure bank deposits. Now, for some, they may be wondering, well, yeah, I heard that there were some bank failures, that happened during the 2000s, but everything's fine now, right? Not necessarily. And people should have some concern about what's going on here. Now, take a look at this infographic. Here in this little house represents the amount of funding that the FDIC has. They have about $25 billion in their funding. Here's another example of it right here. And here's the FDIC building of San Francisco. Okay, so let's read this right here. FDIC insures 7,181 financial institutions. The FDIC is funded by financial institutions that pay for deposit insurance coverage. During the 1980s and 1990s savings and loan crisis, a parallel insurer, the FSLIC, Federal Savings and Loan Insurance corporation went bankrupt. This equivalent went bankrupt during that time. Let's continue. The FSLIC replacement, named RTC, was merged into the FDIC. The savings and loan crisis cost taxpayers $150 billion. The FDIC takes control of failed banks and financial institutions, where it moves to find a buyer of all the bank's assets, including the toxic ones. After the sale of assets, including toxic, usually at discounted prices, the FDIC attempts to cover losses. The FDIC will pay out all insured accounts, followed by applying haircuts to uninsured deposits. Safe deposit boxes, bondholders, stocks, money funds, etc. are not insured by FDIC. So those of you who have stuff in safe deposit boxes, not insured by the FDIC. Due to bank failures during the 2008-2009 bank crisis, the FDIC fund fell to $0.648 billion by August of 2009. You read that correctly. The FDIC went down to $0.6 billion from its $25 billion fully funded amount. We almost lost the FDIC during the 2008-2009 bank crisis. Now, we have a bigger balloon right now. If we have a similar tragedy happen, and if we don't have the ability to rein it in, there's probably a good opportunity or a good chance that the same thing could happen to the FDIC, or maybe even worse. Now let's continue. Subsequent bank failures almost bankrupted the FDIC, so it demanded a 3-year prepayment from banks to shore up its capital. And here I'm going to go down to my final infographic here from Demonocracy. And this is the derivative exposure right now in the United States. Now remember, the FDIC can insure up to $25 billion. We currently have $300 trillion of derivative exposure in these FDIC insured accounts. Here we go. Derivatives are wild financial bets made by banks in order to speculate on hedge risk, ranging from stocks, bonds, all the way to weather. In essence, a casino-style bet. The total notional derivative exposure of the top 25 holding companies is $297,514 billion. Notional means a small amount of money controlling a large position. Bank of America, Merrill Lynch, Citibank, and others have a massive derivative exposure and have moved its derivatives into FDIC insured accounts due to their downgraded credit ratings. Bank of America alone moved $75 trillion to FDIC insured accounts. There's a lot of legal jargon in the way of protecting depositors before derivative counterparties. In the 2008 crash, it was derivatives based on likelihood that debt would be paid that triggered the global economic crisis of 2008. The high rollers of Las Vegas don't know how to roll compared to bankers. The viability of FDIC to save a large-scale bank failure is in question. Now, if you think about this, if we currently have a repo market where banks need essentially to get liquidity every night, billions of dollars of liquidity every night. Now, remember what triggered it. What triggered it was interest rates just skyrocketed to almost about 10% or a little bit more in a night, because some banks didn't trust that the other banks that they were lending to would be able to pay them back. So interest rates just skyrocketed. And that was the cause of, repo madness in September. Now, if we get to a point where banks just are going to be calling bluff and say like, hey, look, I don't trust you paying me back, I'm not going to lend money to you at all, then we may have something that will trigger something similar to what we have in 2008, 2009. So, one of the things that I think about constantly is, well, what will happen, if things just get worse and worse and worse with the issue, which causes so much financial stress to some institutions, some banks, that they say, hey, look, I can't pay you back, or, oh, hey, look, I'm not going to lend to you right now. Uh, and the repo market just doesn't have enough to cover it. What if that financial stress escalates to such a point where the repo market is just like, oh, we can't keep up with this demand. You know, uh, of course, that is just me exercising conjecture in theory, but it's just something that I think about as far as like another linchpin that could just cause this already trying time to get a lot worse. Let me know what you guys think in the comments section below. Again, I'm going to leave both of these links in the description so you can check them out yourselves. Also know that there are other infographics here that you guys can check out and dig into yourselves. But let me know what you guys think in the comments section below. All right. Thanks again for watching this video. It's Black Bullion. Have a good day. Please like it and please subscribe to the channel. Bye.